Okay, we're going to get started. This is Bill Ackman. We're going to present The Art of the Deal. The background here is November of 1987. I was a junior in college, and I bought a book called Trump, The Art of the Deal. Learned a lot. I thought at some point it would come in handy. An apt title for what's to come. We will provide these slides shortly after the presentation. I will post them on Twitter, at which point you could read the disclaimer. I'm going to cover a lot of ground. My colleagues, Anthony Massaro and Manning Feng, on the call with me or on the presentation. We'll start with a brief background on Fannie and Freddie, just to provide some context. We'll get to the conservatorship and the net worth sweep, provide a framework for ending the conservatorship, and then what we call an illustrative GSE restructuring where the entities become public in the next couple of years. Background. Prior to the Great Depression, there was not a 30-year mortgage market. You could borrow from a bank for 5 to 10 years, maybe 50% loan to value. These were floating short-term loans, and this made it more difficult for people to buy homes. Home ownership rate was 45% of the country. Then the Great Depression transpired, unemployment rate hit 25%, housing prices were crushed, a quarter of the mortgages went into default, 10% of homes were in foreclosure, and people couldn't meet the principal payments as they came due. They couldn't refinance, and this led to really a collapse in the banking system. The housing collapse was really a catalyst for a prolonged depression. So the government's response was to try to create more liquidity and kind of longer-term mortgage market. They started in 1933 with something called the Homeowners Loan Corp, issuing government-backed bonds to purchase defaulted mortgages from banks to kind of clean up their balance sheets and create a long-term, really for the first time, long-term fixed-rate mortgage market. 1934, the National Housing Act, which set up the FHA, began this business of credit insurance on long-term fixed-rate mortgages. And in 1938, Fannie Mae was created as a government agency, began by purchasing FHA-insured loans, and the goal, again, to provide liquidity for mortgage lenders so they could make new loans. And it was chartered to support liquidity, stability, and affordability in the secondary mortgage market. They've evolved a lot over time. Fannie's remit expanded to allow them to purchase loans insured by the Veterans Administration, providing liquidity and low down payment mortgages to veterans coming back from World War II. 1954, it kind of adopted this sort of public-private mixed ownership structure. And then 1968, it became a for-profit, shareholder-owned enterprise, and they were allowed to buy non-government backed mortgages. In 1970, they started securitizing mortgages that were issued by S&Ls, and they issued their first conventional mortgage-backed security. And then by 1989, it was a for-profit, shareholder-owned enterprise. This is a graph of Fannie and Freddie's kind of market share and their importance to the supplying credit to the mortgage markets. And as you can see from the chart, their market share only grew post the financial crisis, and been a long-term trajectory of more and more market share for the GSEs. This is the period since the financial crisis, kind of makes it clearer how important the GSEs have become over time. And housing, I think this is well known, certainly, but in particular, the homeowners who are kind of lower and middle income, home equity is an even more important part of their net worth. More affluent people tend to have equity portfolios and other assets, but it's a critically important asset for middle-class America. And the U.S. is really unique globally. Obviously, putting aside not major countries, but even among European, quote-unquote, first world nations, U.S. is an outlier in terms of a 30-year fixed-rate mortgage market. And obviously, the long-term payment plan allows for lower monthly payments, really facilitating the opportunity for a much broader group of people to own their own home. A fixed-rate 30-year obligation that you can prepay without penalty is really an amazing form of financing, and it can't exist in a world with just banks. The banks can't own assets like that and fund themselves with deposits because they end up with massive liability mismatch problems. The US is also really unique globally in financing our mortgage market, principally with mortgage-backed securities. So the GSEs were chartered by Congress to support liquidity, stability, and affordability. And how they do what they do is they have kind of come up with a design for a so-called conventional mortgage, and banks underwrite and as well as other institutions create these mortgages, and then they sell them off to Fannie and Freddie for cash, or they exchange them for Fannie Freddie mortgage-backed securities. Fannie Freddie pool up these kind of warehouse these mortgages until they get to a significant size pool. They stick them in a trust. They issue securities backed by the underlying mortgages, and then they put their guarantee on them. And this has created a global market really for US mortgages. And these are securities that are have never defaulted, and they're enormously liquid. They trade at very tight spreads, and that's really what's created, I would say, as the president would say, the greatest mortgage market in the world. This in turn has provided credit to a very, the sources of capital are really institutions all over the world, and this has enabled our banking institutions to issue these long-term fixed rate mortgages, because they're enormously liquid because of their ability to sell them to Fannie and Freddie, this ability to refinance these mortgages and the enormous degree of liquidity in the MBS market has led to very low cost mortgages. When you look at Fannie and Freddie, they're really in two principal businesses. Kind of the core guarantee business is their mission. But if you look back in time, they got into a business that was not core. And in fact, it was a major catalyst for their failure during the credit crisis. Basically, Fannie and Freddie had a AAA rating, and because of their implied government support, and then Fannie Freddie, in our view, and I think in many people's view, abused that AAA rating, not just to issue AAA rated MBS, but to issue AAA rated corporate debt in enormous scale. And then they used that liquidity to repurchase securities that had kind of lower credit rating, what you might think of as a fixed income arbitrage business. They levered that business, 40 to 1, and that became a meaningful component of their profits. But of course, it created enormous liquidity risk and other risks that were really unrelated to the core mission of the business. Focusing on the guarantee business today, they combined have 7.6 trillion of outstanding mortgage-backed securities. People sort of erroneously think of Fannie and Freddie as something kind of a bank. In fact, they're really best described as credit insurers. Their business is, packaging up these securities, packaging up the mortgages, issuing securities backed by the mortgages, guaranteeing the underlying securities. They get paid guarantee fees or G fees. And these payments are made kind of on a monthly basis as insurance on the security. And it comes out of, it's reflected in the interest, the underlying interest income. The more the housing market grows, the more this business grows over time. And of course, this enormous scale allows them to be the lowest cost provider of this guarantee. They really don't have much, if any, competition. And you can think of this, Pershing Square likes to own these super high quality, durable growth businesses. This certainly fits. It's really an asset light, very high ROE business. It's not reliant on funding from the capital markets. You don't need to hedge interest rate risk, because it's sort of all of the underlying interest rate risk flows through to the owner of the mortgage-backed securities. It's also a low liquidity risk business because when there are defaults on the underlying mortgages, there's no acceleration. Fannie steps in and makes the interest payments, or effectively on the underlying mortgages, so that the MBS holders continue to receive interest and principal, and that gives them a couple of years to sort of work out the loan before they would be forced to repurchase the loan from the portfolio. That really limits their need for large amounts of capital from a liquidity perspective. And these loan portfolios are geographically diversified. They're an enormous number. The underlying borrowers are generally very high credit. And if you look at the housing market over a very long period of time, It's rare that there's a nationwide housing downturn. There are natural disasters, LA being a tragic kind of recent example that will affect some housing markets or a downturn in the economy due to their exposure to, let's say, the auto industry. But a national housing downturn is rare, and the diversification is quite helpful to them. And the requirements for borrowers to have generally substantial, 20% plus equity in their homes, and these loans amortize over time, which is and generally housing prices have increased. So over time, Fannie Freddie's exposure and the risk generally declines as the borrower's equity builds over time. Best understood kind of graphically here, think of a home. Someone paid $100 for the home, or I think $100,000 for the home, and they borrowed $80,000 and they put up $20,000 to purchase the home. The guarantee, the Fannie Freddie guarantee, is on the mortgage, which is the senior most 80% of the value of the home at the time the mortgage is provided to the underlying homeowner. So if the borrower defaults, there's an initial cushion, obviously, in the form of owner's equity, other than if the house has declined in value over time. And if you think about Fannie Freddie's kind of core business, it's really a very low risk business. The goal here is to provide mortgage credit to middle-class borrowers. People buying $1 million plus homes are getting jumbo loans from financial institutions. But the traditional 30-year fixed rate mortgage that Fannie in effect has exposure to is to a middle-class borrower with very high FICO scores, 750. These are very high credit people who pay on time and generally don't default. And the business we think of is, generally low risk, but there are periods, obviously recessions and otherwise, financial crisis being an unusual example, which we'll talk about, where there's a decline in housing prices. But the good news about that is that when there is, and good example is the financial crisis, there's a reset in the value of homes, and people, new buyers come in, buy those homes from, let's say, a distressed borrower. The kind of loan to replacement cost is much lower for the new loan. Underwriting standards tend to get much more conservative after a recession. Rates come down as the Fed and the economy effectively justify sort of lower interest rates. Lower interest rates means the borrower is less likely to default. So there's sort of this recovery that takes place right after a challenging period that's made the business, and a great example is how quickly Fannie and Freddie recovered after the worst housing downturn since the Great Depression. GSEs also play a very important role in the multifamily sort of think apartment market. They guarantee 38% of multifamily mortgage debt. This allows for very low cost and more liquid market in the kind of apartment market. Fannie has these so-called I think designated underwriting, or DUSs they're called, that serve in a capacity to underwrite these loans on behalf of Fannie Freddie. When they meet certain standards, Fannie will step in, guarantee them, issue securities backed by them. We're not going to get into depth here. This is a business of Fannie and Freddie that actually really has not seen any meaningful problems. It's been profitable, and we really think there should be no change. They've managed right through the financial crisis without a problem. If you look at the guarantee fees they've charged over time, they were extremely low in the early days of Fannie and Freddie, and that they have grown significantly since the company's been in conservatorship. Now, why is this? The answer is guarantee fee is very much related to how much capital Fannie and Freddie hold on balance sheet. And in its early days, Fannie and Freddie were only required to hold 45 basis points of equity against their guarantee portfolio. And the result is at a 20 basis point guarantee fee, they could earn an adequate return on equity. I think in conservatorship, the government, the FHFA, recognized that that was not a viable long-term capital structure. Clearly, these entities were undercapitalized during the financial crisis, and so they've taken up guarantee fees over time. Today, they're about 65 basis points, I believe, on average. And then as the existing portfolio kind of refinances into new mortgages, the guarantee fee average of the whole portfolio goes up over time. And if you look at the business, this was generally a very profitable business with very modest credit losses, even during kind of a challenging recession of the early 90s, until the financial crisis, when credit losses spiked significantly. And then the GSEs themselves experienced extraordinary losses during the financial crisis, which we're going to get into some depth on. But then they returned to profitability beginning in 2013 and fairly quickly started generating enormous amounts of earnings. They had 138 billion of GAAP losses during the period from 2007 to 2011. When I say GAAP losses, these are losses that include realized losses as well as accounting reserves and charges they took in anticipation of future losses. The 20 basis, and again, we're looking at the institutions combined here. They held only about $20 billion of capital. That was the 45 basis point minimum capital requirement. Obviously, 138 billion overwhelms 20 billion, and that's why these entities were put into conservatorship. When you look at the actual credit losses, they lost $46 billion. These were the actual realized losses they incurred. So what you recognize is they kind of over-reserved by about $100 billion. But even then, the 46 billion was not, was more than 2 times the capital, so clearly undercapitalized. Now, when you look a little deeper, however, you realize that these, substantial majority of the losses, subprime was an Alt-A was a pretty small percentage of Fannie and Freddie, but it accounted for a very high percent of the losses they incurred. And in the early days of Fannie and Freddie, really up through maybe early part of the 2000s, Fannie and Freddie were not in the subprime and Alt-A business. I think the best I could describe here is that Fannie and Freddie were criticized for their large fixed income arbitrage book. They lobbied to continue in that business, and then they got pressure to underwrite lower and lower kind of credit-worthy loans. It was a dangerous combination, and the result is these loans accounted for a meaningful percentage of the losses. Now, if Fannie and Freddie had never gotten into the subprime and Alt-A business, if you just look at their actual losses in terms of realized losses on non-subprime, non-Alt-A, collectively they lost 27 billion. They held 20 billion of capital. So actually, the 20 billion, 45 basis points was almost enough to cover the losses during the financial crisis, but clearly they were still under capitalized. Fixed income arbitrage business hit 1.6 trillion of assets at the peak. This was a 40 to 1 levered business where they kept a 100 basis point spread, and with the leverage they earned a attractive ROE. But this was non-core to the mission, very dangerous business, and really taking advantage of this implied government guarantee. Alan Greenspan kind of alerted the world. Federal Reserve has been unable to find any credible purpose for the huge balance sheets built by Fannie and Freddie other than the creation of profit through the exploitation market granted subsidy. They were criticized for this, but they continued on in this business. Warren Buffett, the portfolios are what really got them into trouble. The portfolios were the ways that the managements of Freddie and Fannie tried to juice up the earnings, basically because the insurance guaranteed that they were given that mortgage. I always thought that made a lot of sense, but the portfolio operations enabled both of these entities to use, in effect, government-related borrowing costs, sort of unlimited credit to set up the biggest hedge fund in the world. This was a business they should not have been in. Complex, low return, high risk, high leverage, high liquidity risk. No real competitive advantage, and they had to use a lot of derivatives to hedge risk. And this was a proximate catalyst to these entities' problems. To the credit of the conservators and to Fannie and Freddie, they were, required to reduce this book of business, and they did. They took it down very substantially from over 1.7 trillion to now 182 billion. They're capped at 450 billion, but they do need the capacity to own assets on balance sheet, but these are either mortgages that they're pooling up, kind of warehousing in anticipation of a future securitization. This could be a very safe securities portfolio. Think an insurance company holding assets on balance sheet, just in terms of fixed income, low risk assets that they can, like an investment portfolio. But these portfolios should be in much more modest size, and today they are in a good position. So now let's talk about conservatorship and the net worth sweep. The GSEs were put into conservatorship on September 6, 2008. The objective was returning them to normal operations when their business stabilized. I quote here James Lockhart, the FHFA director, on the day they announced the conservatorship, that therefore, in order to restore the balance between safety and soundness in mission, FHFA has placed Fannie and Freddie into conservatorship. That is a statutory process designed to stabilize a troubled institution with the objective of returning the entities to normal business operations. FHFA will act as the conservator to operate the enterprises until they are stabilized. And the government made a very tough deal with Fannie and Freddie. I'm sure all of us remember the government stepping in and injecting senior preferred stock into all the big banks, AIG and others. Really only AIG and Fannie got the tough deal. The tough deal was senior preferred at a 10% coupon, and then warrant dilution, warrants for 79.9% of the common stock. And during the period 2008 to 2011, they were unable to make the cash dividend payment. So the Treasury provided more liquidity and kind of paid themselves with the proceeds of new draws on the senior preferred. The preferred, by its terms, interestingly, had a PIK provision where they could PIK at a 12% interest rate. We don't really know why they chose to PIK as opposed to continue to draw more and more from the Treasury. Beginning 2012, as I mentioned before, these entities recovered very, very quickly as their guarantee business and their market share expanded dramatically as other players dropped out, and guaranteed fees were raised. They became enormously profitable, and they were able to start paying the 10% dividend. So if you look at the chart, you saw the early years where they couldn't make the payments because the entities were losing money. They started making money in Q1 of 2012. And then interestingly, something called the net worth sweep was announced on August 17th, and they amended the terms of the senior preferred stock to require the GSEs to pay out all of their dividends, pay out dividends equal to 100% of their earnings. And sort of the stated purpose here is they said, look, Fannie and Freddie are never going to be able to pay us back, so we're just going to take 100% of their earnings. As what came out in the litigation, there was a big concern on the part of the Obama administration. They did not like Fannie and Freddie and the market power and the power they had over Congress. And basically, they decided to make sure these entities could not recapitalize. And so the net worth sweep is announced and it begins. And then, literally the next quarter, the companies are required by their accountants to reverse these very large reserves that they had taken. And now all of a sudden they become enormously profitable. And all of those earnings are swept away by the government with no credit toward the interest or to the coupon on the preferred, and no credit toward principal payments. If you look at all the payments that the government has received over time, and you treat them first to cover any unpaid accrued dividends, or I'm sorry, coupon on the preferred, then the balance goes to amortize the preferred over time, and you do a calculation of the return that the government has earned. The government has earned more than their contractual 10% IRR. They've received $301 of dividends, and that returned all of the $191 billion that has been borrowed, plus an extra $25 billion, because again, it was a sweep of 100% of the company's earnings. And so the government's actually been paid back more than 100% of what they were owed. And if you look at all of the government bailouts or the big ones during that period, Fannie was the biggest, and it was by far the most profitable. So this is the government at its best in terms of stepping in when needed, saving these institutions, and taking a real pound of flesh. And this profit does not include their 79.9% ownership of the company through penny warrants. When President Trump was elected in 2016, Steve Mnuchin became Treasury Secretary, and his stated goal was to end the conservatorships. And the most important thing he did was suspending the net worth sweeps until the GSEs are fully recapitalized. And that enabled, the net worth sweep basically made these institutions nearly insolvent because they had really no equity at all, because government would sweep away all the profits. And then with the termination of the net worth sweep, these entities have been able to recapitalize. Interestingly, January 2nd, the current Treasury Secretary, the FHA director of the Biden administration, made some amendments to the preferred stock purchase agreements, including a right to consent from the Treasury for a release from conservatorship, a commitment to conduct a market impact assessment. But in short, we don't believe these changes, kind of last minute changes in the Biden administration, one, will have any kind of real effect. And the new Treasury Secretary, Scott Bessent, subject to his confirmation today, which I'm sure will go quite well, and the new FHA director are free to modify these terms. So let's talk about ending, how we believe the conservatorship should be ended. This is a letter from President Trump. It's worth reading the whole thing, but we'll highlight this paragraph. He says, this is November 2021. He says, my administration would have also sold the government's common stock in these companies at a huge profit and fully privatized the companies. The idea that the government can steal money from its citizens is socialism and is a travesty brought to you by the Obama-Biden administration. My administration was denied the time it needed to fix the problem because the unconstitutional restriction on firing Mel Watt. Basically, Trump administration, Steve Mnuchin, ran out of time to get these entities out of conservatorship, but we're obviously grateful for President Trump's public statement to that effect. Now, obviously, a lot of debt has been put on our government's balance sheet over time. We have Doge, Elon, and Vivek underway to help us reduce cost. But in addition to reducing costs, we should look for other assets. And there is a very large asset here in a proper release from conservatorship where the government could recover. We estimate $300 billion with no impact on Fannie and Freddie's ability to provide 30-year fixed rate mortgage financings at low cost with tremendous availability. So for context, of course, this is not the first conservatorship in the history of the United States. There have been thousands, I think more than 4,000 conservatorships for banking institutions that have failed. These are always designed to be temporary periods where the government steps in, protects depositors, usually in a banking institution, and then sort of winds down the entities in a way to maximize the value of the assets, respects the hierarchy of claims of the various sort of participants, and puts them back into the private sector as promptly as practicable. And that's what was started during the Trump administration, and the elimination of the net worth sweep and the inherent enormous profitability of these companies has enabled Fannie and Freddie to build $131 billion of capital from a zero start at the beginning of the Trump administration. The Biden administration really took no action on Fannie and Freddie. And the good news is we think now that Trump is a few days away from being back in office, he and his team could put these entities on the path to be released within 2 years. The government warrants, we believe, are worth more than $300 billion. This is a highlighted paragraph, and it's important. Our release from conservatorship does not require any action by Congress. So this is not something that has to go to Congress for approval. They can exit conservatorship as soon as they get approval from Treasury and FHFA. So the objectives for the country in ending conservatorship is, number one, most important, maintain the availability, affordability of the 30-year fixed rate prepayable mortgage with no changes. Protect taxpayers from bearing the cost of a future housing downturn. So the government here has to be protected. We want to minimize the government's involvement in the housing finance system. We want to maximize the probability that these entities raise the capital. They'll need some capital to emerge. We want to maximize the taxpayer profit on the Treasury's investment in the GSEs. Now, how do we do that? We exit conservatorship by setting one, appropriate capital requirements for Fannie and Freddie. We restrict the government granted benefits that they've historically had. We make sure that we have market-based compensation and best-in-class governance at the companies. Fannie and Freddie have seen enormous turnover in leadership at the company because the executives are contractually underpaid. They're paid below market compensation. There's no equity compensation, and it's kind of a thankless job to run these institutions. And the result is there's been enormous turnover. These are the largest, probably the largest asset institution in the world, and you want stable, high quality leadership. That's a critical element. And then we want to clarify the nature of any ongoing government backstop. Big part of the problem here was the government backstop historically was implied. That's not ideal for the people who buy securities, and it's not ideal. It created this big part of creating this mess. So the question is, how do we set the right capital levels? So the FHFA's capital rule was finalized in 2020, was amended in 2023, increased the capital requirements for the GSEs. And that was important because 45 basis points, as I've shown, was inadequate. The mistake they made, however, is they went, they increased the capital requirements by nearly tenfold to a level that is well beyond what even Jamie Dimon would call a fortress level balance sheet, creating a near impossibility in terms of the ability to recapitalize these institutions. So how do we think about what the right capital levels are? Well, let's start by comparing the capital requirements that banks are required to hold when they hold mortgages. So when banks hold mortgages on balance sheet, mortgages have a risk weighting of 50%. Their tier 1 capital ratios under Basel III are between 7% and 9.4%. So in effect, they need to hold 3.5% to 4.7% capital against mortgages. Now, why is that? Well, one, unlike the GSEs, they do a broader range they take more credit risk on the mortgages that they underwrite. They actually own these mortgages on balance sheet, so they have the interest rate associated with these mortgages. They fund them on balance sheet again, so that creates liquidity risk for them. And they do jumbo and various alternative mortgage products. Now, importantly, the GSEs, as I mentioned, high FICO score, relatively, conservative loans to middle class creditworthy borrowers, so lower credit risk than banks. The GSEs do not take interest rate risk because they pass along the interest rate risk to the buyers of the underlying securities. I pointed out, because again, they're not holding other than a portion on balance sheet that are warehoused in anticipation of future securitization. It's not a balance sheet intensive business. And even when the mortgages default, the requirement is, there's no obligation for them to buy a defaulted mortgage out of the pool for 2 years, which gives them time to work out a transaction. And they are not in the business of jumbo or alternative or subprime mortgages or subprime any longer, for sure. The question is, what's the right number? We think, and as do others, that the mistake some people make is thinking about the GSEs as if they're banks. They're really insurance companies, credit insurance companies. And we think, therefore, the right way to think about them is in the context of the capital standards for other kinds of credit. Insurance companies, this is a quote from the Mortgage Bankers Association: insurance regulation is also more likely to see a stream of future premiums as a source of loss absorbing capacity, hence looks to be sure that pricing is sufficient to cover losses under all but the most catastrophic scenarios. In MBA's portfolio, with the guarantors having only a minimal investment portfolio and holding assets of short duration, insurance regulatory concepts may become more applicable than bank regulatory concepts. So the idea is, as they've now shrunk this fixed income arbitrage business to basically a warehousing business as opposed to fixed income arbitrage, they're now nearly pure guarantee companies, credit insurers who should look at insurance standards. So the private mortgage insurers are credit guarantee companies that guarantee mortgages. Now they're different from Fannie and Freddie, and that the private mortgage insurers, or the PMIs, they're where you go if a borrower comes in with a very modest down payment or other credit, kind of lesser credit, and in order for that loan to be purchased by a Fannie and Freddie or to be underwritten, the borrower has to obtain credit insurance on the junior most 20% of that loan. So the PMIs are exposed to credit losses on a first dollar basis generally, on the so kind of the most junior 20% of the loan. So it's obviously very high loan to value. And they're guaranteeing this 80 to 100% loan to value tranche. And they also do jumbo and alternative mortgage products. Their credit requirements were in the, I think, 400 basis point range. Actually, Fannie and Freddie required them to increase in order for PMI, private mortgage insurance, to be considered on a Fannie Mae Freddie Mac underwritten loan. The requirements for the mortgage insurers are at 5.6%. The regulatory capital requirements are generally a state-by-state thing, but the market power of Fannie and Freddie has really caused all the PMIs to have to adopt this higher capital standard. But as you can see graphically, Fannie and Freddie are exposed to the not exposed to the first dollars of loss, whereas the PMIs, if there's a mortgage default, they typically will lose their entire the entire guarantee will be called. Or in the case of Fannie and Freddie, the severity is much lower because they have a first mortgage on the property. They're protected by borrower equity and amortization sort of over time. Now the issue, I think after a financial crisis, the instinct is to say, well, 45 basis points is enough. We've got to come up with a number that is so large that, and I think we went another extreme. Here's again, Mortgage Bankers Association. They say to generate the large amount of private capital required to fund such a system, that is a system with a 4% capital requirement, the guarantor business model and expected returns through the cycle need to be attractive. That is, private investors and the guarantors would have a reasonable expectation of a market rate of return on a risk-adjusted basis. To achieve this objective, investors would want to ensure that capital requirements are not too high, regulation and supervision is not too expensive, credit standards are sound, and efforts to make housing more affordable do not impinge significantly on returns. We think this is a very good framework. But the problem is the 4% capital requirement is too high. The result of that would be, one, these institutions would have to have $270 billion of capital. We believe that's more than 100 billion of capital, well beyond a fortress balance sheet. That is, to raise that incremental capital, we believe that Fannie and Freddie would have to generate higher returns for investors. This in turn would require higher guarantee fees. Guarantee fees have already gone from 20 to about 65 basis points. They would have to go as high, we think, as 90, 95, perhaps 100 basis points for the GSEs to earn a high enough return to attract the capital. Really the way to think about this, the same way to think about banks. Obviously you want a bank that will never, fail. So higher capital therefore is better, but you don't want capital requirements to be so high that banks are not viable businesses, and therefore they can't raise capital from investors, and they can't provide, perform their function of providing credit to the world. The same is really true for Fannie and Freddie. Getting a little more granular, the incremental costs of if they had to hold 4% capital would be as much as, on a relatively, $500,000 loan, about $25,000 of incremental interest to the homeowner from the higher capital requirements, assuming it was actually possible to raise this large amount of capital, which we do not think is viable. So kind of lining them up, the GSEs are in a low credit risk business. They don't have interest rate risk. They don't have liquidity risk. They don't make high loan to value loans. They don't guarantee. Their guarantee does not apply to the 80 to 100% loan to value tranche. They're not in the jumbo and alternative business. We believe the right number is 250 basis points, or 2.5% equity, common equity capital. That compares with 3.5 to 4.7% for banks, which again have much more liquidity risk, interest rate risk, and their credit quality and the nature of the underlying loans is much riskier. And then, of course, lower than the private mortgage insurers, which is the really, really high risk business of guaranteeing junior tranches of the value of a home. 2.5% equity capital combined for the two institutions, about 170 billion, based on their 6.7 trillion of guarantees. That gives them 5.5 times as much capital as that they were previously required to hold. And we look to the Great Financial Crisis, which was the worst housing downturn in the existence of a 30-year mortgage market. When you look at the cumulative credit losses, the actual realized credit losses during the financial crisis were 27 billion. Clearly, the 168 billion would have comfortably covered those losses during that period. Even if you include their subprime and Alt-A exposure, businesses they're no longer in, 168 billion would be almost 4x the amount of capital. And we think of this as we want the GSEs to have an unquestionable fortress level balance sheet, 6.2 times the cumulative actual losses, excluding losses from lines of business they're no longer in today. This is Keefe, Bruyette & Woods. and they concur. While GSE revenues and earnings are significantly higher now versus pre-GFC levels, driven by much higher guarantee fees, meaningfully larger guaranteed portfolios, required minimum capital levels have increased far more meaningfully, resulting in a sharp decline in run rate ROEs. We believe that the only realistic way to solve for this is to remove the stability buffer and take the minimum capital level back to 2.5%. The other alternative to increase guarantee fees, we estimate the increases would have to be the 20-25 basis point range, which is likely to be politically unacceptable since it would increase mortgage rates by an equivalent amount. One thing that people don't talk about, but is actually a critically important part of the I would say, stability and strength of the Fannie and Freddie guarantee is off-balance sheet asset they have, which is that Fannie and Freddie have a nearly $7 trillion existing portfolio on which they collect guarantee fees. This is a recurring, not, the zero CapEx royalty stream. And if they stopped issuing new business, the world ended, they'd continue to receive this 32 billion of net revenue that over time declines as people refinance more. If they've lost market share, this would sort of go down over time. But this is a very important part of their credit strength and their ability to recapitalize after a challenging period. We believe if you value the present value of the G fees is about 101 billion. If you kind of present value out these, discount these back, their contractual fees that we expect them to receive, while it's not reflected on the balance sheet, it's an extra 101 billion of credit support. And as I mentioned before, after there is a cataclysmic moment in the credit markets, housing markets, really the other competitors that are not nearly as well positioned as Fannie, they don't have the capital, the scale, the market share, the dominance, they take a lot of market share. And you saw that in the chart as their market share grew significantly. We try to estimate, and the assumptions are presented, what the value of this incremental ability to kind of take market share after crisis. We think that's worth another 17 billion. So it's like 128 billion of sort of additional sources of funding, capital, and value. Really, it's a form of capital that you don't see on the company's balance sheet. So when, again, benchmarking off of the worst housing crisis since the creation of Fannie and Freddie, whether it's the 46 billion, their actual cumulative credit losses, 27 billion, excluding subprime or Alt-A, versus our proposed capital levels, a 6.2 multiple of the actual losses. When you add in the existing book of guarantee fees plus the ability to write new business during the crisis, now we're talking a towering amount, 286 billion, literally 10x the losses, in excess of 10x the actual credit losses on lines of business that they remain in. Obviously, the conforming loans versus the subprime Alt-A book of business. Now, there's certain government granted benefits that Fannie and Freddie receive that we think they should no longer receive. So one, they're exempt from SEC registration of debt and MBS. We think the SEC does an excellent job overseeing securities issuers, so we do not think they should have an exemption. They have a line of credit of $2.25 billion that was put in place many, many years ago. One, they don't need it. And two, this was sort of part of the perceived implied government support. We think that should be ended. They were exempt from all GSE securities were exempt from the Volcker rule. This kind of created their ability to have effectively an unlimited amount of corporate debt that they use to enter the fixed income arbitrage business. We think they should only have this exemption with respect to the GSE mortgage-backed securities. Lack of exposure limits for banks investing in Fannie Freddie debt. Again, here, we want people to differentiate between the mortgage-backed security guaranteed by Fannie and Freddie versus the corporate debt of Fannie and Freddie. There should be, and this will reduce their unlimited ability to borrow money. Query where these limits should be set. They were exempt from FSOC, the Financial Stability Oversight Council review for SIFI status. Again, we like the idea. These are clearly, very important, systemically important institutions that deserve to be continued to be reviewed. benefits they receive that should be preserved. They get a 20% risk weighting for GSE MBS when a bank has to think about holding capital against mortgage-backed securities, a lower level than private level mortgage-backed securities. We think this is appropriate in light of the very, very low risk nature of Fannie Freddie MBS. MBS should be eligible for purchase by the Federal Reserve in light of safety and other reasons. GSE MBS should be eligible as collateral for public deposits and for loans from the Federal Reserve Board. And then this one, no requirement for information disclosure underlying the securities ratings. The to be announced market, you want all GSE MBS to be fungible. You don't want people like looking to see who's got LA exposure this month and all of a sudden the securities start trading at different spreads. It's actually a case, interestingly, where less transparency is better for the market, and so we think this is an important benefit. Compensation, as I mentioned before, there's been enormous turnover. Fannie's had a new CEO every 3 years, Freddie every 2 years since conservatorship began in 2008. Yeah, it's really hard to run a company when you have a revolving door in the CEO seat. I think a big part of this relates to being able to compensate people appropriately. Market-based salaries, bonuses. We like the idea of restricted stock with long-term vesting. We want a thoughtful person running the compensation committee. You want to emphasize capital strength, operational risk management controls. And then you need a world-class board of directors who take on this job and understand the importance of, these entities support the housing market for middle-class Americans. They're critically important. We can never let what happened happen again. And again, the board here should not receive big cash payments, but rather restricted stock with long-term vesting. And even when you leave the board, a period of time thereafter before you can get the benefit of that compensation. Importantly, we think, some people have said, oh, we're going to need an explicit government guarantee of Fannie and Freddie mortgage-backed securities. We think this is a mistake. We do not think it's necessary. We don't think it's feasible, and we think it's not desirable at all. The complications would require the consolidation of $7.6 trillion of mortgage-backed securities on the government balance sheet. That would add another $7.6 trillion to the $35 trillion we have outstanding. That's a catastrophe. We think it could be disruptive to the Treasury market because you have unsecured U.S. government obligations, the general treasuries, and then you'd have secured MBS. This could lead to a repricing of the unsecured versus the secured. This, of course, would require an act of Congress. We think it's just not a viable alternative. We do think it's, however, very important to clarify the nature of the relationship between the GSEs and the government. This implicit guarantee was a problem. We think the government should provide some support. We'll be very clear what that is, and that the taxpayer should be compensated for it. And the market does need a explicit understanding that there is some form of government backstop. So in connection with the bailout, if you will, of Fannie and Freddie, the government set up these preferred stock purchase agreements, which today have a $445 billion availability, as long as the people deem the senior preferred stock is repaid. I'll get to that kind of momentarily, but that would be a very substantial backstop in addition to a fortress level balance sheet, in addition to the other forms of recapitalization that exists by virtue of the guaranteed fee and other portfolio. A bit like deposit insurance, but in this case, a government funding commitment. Treasury would be paid a commitment fee in exchange for this support. We think that commitment fee should be priced on a market basis. We think of this as a super senior obligation where the probability of being called upon is very, very close to zero. We'll give you our sense of where that should be priced. This would require a modification of the terms of the senior preferred. We can't be in a world in which the Treasury willy-nilly can step in and inject senior preferred into the company. There has to be real clarity around when and if that would come in. So again, looking at the 27 billion of cumulative losses as kind of a benchmark, the 138 billion includes the GAAP reserves that were taken at the time. Here we have 168 billion of equity. We're ignoring for a moment the additional claims paying resources that come from the contractual stream of guarantee fees. And we layer on top of that the ability to draw $445 billion from the government. So you've got $613 billion of draw capacity versus $27 billion to $138 billion, whether you take the gap over reserving or the actual credit losses. And clearly the world will look at this as a massive capital stack to protect against future losses. Interestingly, just about a week ago, Fitch came out with a ratings report where they said current ratings referring to the ratings of Fannie and Freddie, reflect support provided by the U.S. Treasury Department under the senior preferred stock purchase agreements and Fitch's view of the GSE's policy role in the U.S. housing market. The PSPAs require the U.S. Treasury to inject funds if either GSE's net worth drops below zero up to the agreement limits. As of Q3 2024, aggregate availability in the PSPAs exceeded $250 billion. The housing GSE's combined net worth at $147 billion, currently indicating strong U.S. government backing. Fitch expects the incoming Trump administration to potentially explore options for taking the GSEs out of conservatorship. If the GSEs were to exit conservatorship while maintaining the PSPAs or similar support, their ratings could remain aligned with the U.S. sovereign rating. So an early indication this approach works from the rating agencies. How do we price this? Again, in light of the very, very large amount of capital that comes before and the very low probability that these would be called upon, they should be priced like similar obligations. It's a bit like a undrawn revolver. Those fees are, for an entity of a AA minus or better, it's 4 basis points. If you look at single name CDS pricing for high quality credits from Berkshire to J&J, anywhere between 13 and 23 basis points. Again, perhaps some people would like to, punish the GSEs by making this a very high fee. Obviously, the higher the fee, the higher the G fees, and therefore the higher the mortgage costs. We think it should be priced on a market basis, but not on a punitive basis. And our number is 25 basis points, which we think is an appropriate, fair, but not overpriced cost for this exposure. So now we're going to get to our restructuring of the GSEs. So the first and critically important step, as I mentioned before, the senior preferred has received more than its contractual 10% return. They've received 11.6%, and $301 billion has been sent back to the government, which means the $191 billion has been fully repaid with 11.6% interest. Well, it's from an accounting perspective, the government leaves it on the balance sheet of the entities. It should be wiped off the balance sheet. The existing PSPA should be amended to serve as a backstop going forward in exchange for a commitment fee. Again, we talk about a 25 basis point commitment fee. The Treasury bargained for and received warrants on 79.9% of the common stock. They retain them. The existing junior preferred can either be left outstanding or converted to common stock on a negotiated basis. Our plan here is for a re-IPO of Fannie Mae by the end of 2026, i.e. in a little under 2 years. It will only require $5 billion of fresh capital in order to meet the capital standards by December 31, 2026, and then a re-IPO of Freddie Mac by the year end 2027, at which point they raise $15 billion. We like the sequential nature here. Freddie needs a little more time to recapitalize anyway, but the market will have the benefit of 1 year of Fannie experience before the Freddie IPO. Once both businesses are public, we want the government to sell down its stake, kind of long-term program over time. That's the basic kind of business plan. So now we start to look at the entities separately. The Fannie drew $121 billion. They've returned $181 billion. It's been 11.2% IRR to the government. Freddie drew $73 billion. They've returned $120 billion. That's been a 12% return combined, as I mentioned, 11.6% return, $25 billion extra. In our plan, we're allowing the government to keep the $25 billion extra. It's kind of hard to get money back from the government. And we're just trying to, move forward in a way that has the highest probability of getting done. This is a quote from a former member of the Trump administration, counselor to the Treasury Secretary Mnuchin. He says, so it's an 11.5% moment. He's referring to that IRR on the senior preferred, and it just shows that, that there's an opportunity here to protect the taxpayer. The taxpayer has actually been in some ways, in many ways, repaid from the bailout of Fannie and Freddie. We got to kind of turn the page, fix it, and move on. This was an interview in May of 2019. Interestingly, if the government didn't keep the 25 billion, that is more than sufficient. If they return that capital, the excess payments that they were not contractually owed to the institutions, both institutions, Fannie could emerge 2026 in effect in a direct listing. It just could be released for a conservatorship, and Fannie by the end of 2027. So we obviously, if we respect conservatorship, we don't need to do an IPO. So this is another alternative. But again, if we don't get the money back from the government, we're going to need to raise some capital in the case of Fannie Mae by year end 2026. The company will have 111 billion of capital. We're assuming a $5 billion IPO at that point in time to get them to the 2.5% capital ratio. Again, what we estimate to be about $4.65 trillion of outstanding guarantees at the time. So here's kind of the bridge. Today they're showing negative GAAP common equity. So what gets that to the restored capital levels is $32 billion of income over the next 2 years. This is the 121 billion is the kind of wiping off the balance sheet, the senior preferred. It's now deemed repaid because it has been 5 billion of re-IPO proceeds. That gets you to 97 billion. And then in our model, we're converting the junior preferred to common equity at the IPO price for the $5 billion. That gets you to a pure common equity capital structure of $116 billion. Freddie has been growing more quickly than Fannie, and as a result, the capital requirements it's not as well capitalized, if you will, as Fannie, which means that by the end of 2027, it will have to raise about $15 billion. Obviously, after the successful re-IPO of Fannie, which we think will be an enormous success, 15 billion we think is not a huge reach. Here's the bridge today showing minus 35 billion of GAAP common equity as of the end of Q3, 33 billion of income over the next 2 years. We credit we wipe the senior preferred off the balance sheet because it's been repaid. We do a $15 billion IPO, gets you to 85 billion, and then we convert the junior preferred. It's exchanged for common stock in the company on a par value versus the IPO price of the two companies. With respect to the junior preferred, it's a non-cumulative perpetual security. There's no obligation to pay dividends. If they're not paid, they don't accrue. We think the holders would be, because you can leave them outstanding. By the way, we own junior preferred securities as well, in addition to common. The choice for Fannie and Freddie is just to leave them outstanding or convert them to common stock at the IPO price. That's a much more favorable outcome for the junior preferred because they get to come in, they convert their par value into common stock, a much more liquid instrument at a discount to where the stock's expected to trade post IPO. So we think this will be the every preferred holder will choose this option. Again, Fannie and Freddie fully recapitalized by the end of 2026. Freddie Mac in a $15 billion IPO by the end of 2027. Benefit of doing Fannie first is one, it's a very modest sized IPO. I mean, it's actually 5 billion is a decent sized IPO, but modest in the context of IPOs that have been done. It allows the market to kind of observe Fannie and Mae, gives Freddie more time to prepare, gives the kind of market time to kind of re-understand these business models. It's a smaller IPO. I expect it to be massively over subscribed. And then Freddie, of course, can apply the learnings to its own test. Just to give you context on the size of these IPOs, these are, they're IPOs of much, much larger scale that have been done, years ago compared to these are very executable. And I've even heard banks, well-known Wall Street banks are getting involved to obviously be in position A to be part of these IPOs. The model. Anthony, doing a lot of talking. Why don't you walk through how you built the model here?
Sure. Thanks, Bill. So we've basically kept a lot of the economics of the business in line with today. So the 2.5% capital is kind of elegant in the sense that it allows the entities to earn what we think is an appropriate return on equity, while leaving G fees unchanged. So we model long-term G fees of 65 basis points. That's exactly where they are today. This would have to kind of adjust up or down over time as kind of the underlying economics of the business change, if they do at all. We don't anticipate much changes in them. They're kind of simple businesses. But idea is you have a G fee that targets a low double-digit return on equity. We assume no change in market shares from today's levels for Fannie or Freddie. We model a commitment fee, as we discussed on the prior pages, of 25 basis points per annum on the total amount of the undrawn PSBA commitments. If they were to draw any funds here, which they would only do if their capital were exhausted, the interest rate on the drawn amounts would be significantly higher than that. And credit losses, G&A expenses, other expenses, we model in line with long-term historical levels. The investment book, we grow in line with the single family guarantee business at 2% per year. The idea here is that it is used solely for two things. One is temporary warehousing of mortgages prior to when they're put into MBS trusts, and then also buyouts of non-performing loans from existing MBS trusts. We don't model kind of any investment beyond this. Basically serves as a function to assist their core business of single family. No changes to the multifamily business, as Bill mentioned earlier in the presentation. And, we model these entities paying out 90% of their net income as dividends once they're fully capitalized. The idea here being that, they're not going to use their capital to enter any other lines of business. We think they need to be focused on their guarantee business. This shows our financial projections for Fannie Mae. I've shown the first 5 years post-IPO plus 2035. The reason we picked 2035 is, as you can see, it takes some time for the average portfolio guarantee fee to converge with the guarantee fee they're charging on new acquisitions of 65 basis points. We model that will happen, by kind of 2035, plus or minus, obviously. The TCCA fees are a fee that Congress enacted in 2011, 2012. It's a little bit strange. They take 10 basis points of the guarantee fee that the GSEs charge, and they used it to fund a payroll tax cut. Once Congress kind of starts charging a fee, they rarely let it go. So they extended this. It was originally supposed to expire in the early 2020s. They extended it through 2032. We don't assume that it actually lapses. If it does, there's an opportunity to lower mortgage costs there, which we think is attractive. Credit losses, we model in line with long-term historical levels. The long-term historical average credit losses, excluding subprime Alt-A, were about 9 basis points since 1990 for Fannie, 12 basis points for Freddie. We're modeling 10. They're a lot lower today. They're in the low single digits, but we're kind of trying to take a long-term view here. No change in kind of G&A expenses from current levels. It gets you to a long-term margin on the single family business of 30 basis points, which at a 2.5% capital ratio allows Fannie to achieve an 11.9% return on equity on new business. The long-term earnings growth here is 3%, kind of reflects the steady nature of the business. Go to the next slide. This just shows the same analysis for Freddie Mac. I won't spend too much time on it. Again, solving to kind of an 11 to 12% return on equity, same earnings growth profile long-term. So our valuation of Fannie Mae. So we've tried to take a very kind of straightforward approach to valuation. This kind of most bedrock valuation framework is kind of the dividend growth model. So we model 2035. We project the dividend that Fannie Mae would pay in their common stock to be about $2.23. That dividend should grow 3% in perpetuity. We've assumed an 8% cost of equity, which implies a 5% dividend yield. We think that's quite attractive, kind of a 5% yield growing at 3%. And then that implies a share price of $45 about 10 years from now, which implies 15 times forward earnings. We discount that back at the 8% cost of equity and add all of the interim dividends between 2026, the IPO, and 2034. And that gets you to an implied fair value per share at the end of 2026 of about $35. And then we assume that Fannie's $5 billion IPO is done at a 10% IPO discount to that, which we think would be sufficient to attract the demand that's needed. This implies kind of a six-fold return from current share prices. this shows the same analysis for Freddie Mac. We're showing them go public a year later, given that they need to raise more capital. Or, retaining earnings in 2027 helps a lot with that. We get to a similar value. We get to $39 per share value here. But important to point out that that's at the end of 2027. So if you actually roll Fannie forward, they're both worth kind of in the high 30s in our estimation at the end of 2027. And we're assuming a IPO discount of 15% for Freddie, since they're raising significantly more money. They're raising 15 billion in our model versus 5 for Fannie. So we think a larger discount to entice that demand helps, and it doesn't really change the fair value that much. Go to the next slide, please.
You forgot to say it's a 7-fold return versus the current
Oh,
share.
that's right. That's right. And this is a 7-fold return from current share prices, which is obviously extremely attractive. So it's interesting. We're modeling IPOs. You may have noticed at more than $30 per share for both companies, but the stocks today are at between $5 and $6. How is that possible? So why don't I turn it back to Bill to talk through an investment that he led where this played out exactly in the same way.
So the most successful equity investment we've made at Pershing Square was our investment in General Growth Properties. We bought 25% of the common stock of the company beginning at 34 cents a share. The stock had dropped 99.5%. This was November of 2008. I think our average cost was around 60 cents. And there's very kind of important sort of analogies here. It wasn't in conservatorship, but it was in bankruptcy. It was in bankruptcy not because it was insolvent, but it couldn't pay its debts as they became due, and the credit markets and the CMBS markets shuttered. So I joined the board in around I guess April or May of 2009, and we were pretty proactive in working obviously with the court and the judge and explaining our story about how the problem, how the entity was in fact actually solvent, how there was real equity value. We also were pretty forward-leaning in making public presentations to shareholders, and we gave a presentation called "The Buck Stops." The Buck's rebound begins here. Play on the Bucksbaum family name. I remember exactly when that was maybe May of 2009 when the stock was around $1, and market took more and more interest in the company. And then as the company made progress, court approved our paying common dividends. Very, very important initiative is we went to the New York Stock Exchange and we said, look, we got a solvent company. We have the stock trading, $10 a share. Or maybe it was more like 5 at the time. I have to look up when we went to the exchange, and they said, well, we have a rule that says that bankrupt companies can't remain listed on the exchange. And I said, well, this is not, you do that to protect investors from stocks that are going to be worthless. This is a stock that's going to be worth a lot of money. And to the exchange's credit, they went back, reviewed the rules, and they said, we're going to change the rule because of this unique sort of circumstance. So we got the company relisted on the New York Stock Exchange. A woman by the name of Tara Zizek was the person at the exchange back then, very early on in her career, who was the person I interacted with. I'll get back to why I mentioned her name. And then as we made continued progress toward the eventual exit from bankruptcy, the stock continued to rise until eventually we did an IPO. We did a backstop rights offering for the company to merge from Chapter 11, which valued the company at $14.75 a share. We raised $2.3 billion it was a very large IPO. It was a backstop rights offering for a piece of the business and I guess a secondary primary offering, a primary offering of stock for the company to emerge. Let's talk about. Actually, I want to jump to one. I mentioned Tara Zizek, so I want to get to another slide. Where is my New York Stock Exchange slide?
Right there.
All right.
There.
Yes.
Yeah.
So the good news is Tara Zizek is still at the New York Stock Exchange. She's now head of listings. And so I called her and told her about the situation. And the New York Stock Exchange would be happy to relist Fannie and Freddie because they meet all of the criteria for a relisting. The only thing needed is the conservatorship, the conservator's approval. But I do think it's in the interest of the conservator for the listing to take place, because there are many investors who are not permitted to buy pink sheet or OTC securities who could buy the stock. You bring in other investors, obviously, that starts putting you on a path to doing an IPO at a higher price. The higher the price of the IPO, the less dilution to the government. Therefore, the more value that can be created for the US government. So why don't we get back to valuation? I'll turn it back to Anthony on page 92.
Sure. Thanks, Bill. So there's obviously no perfect comparables out there for Fannie and Freddie, given that they are perfect comparables for each other, and they're both in conservatorship, so you don't have something to benchmark them against today. So you kind of have to look at the universe of what's out there. So the two universes that we thought made sense to look at were one, property and casualty insurance companies, given that these are credit insurance companies, and then second, regulated utilities. There's important differences with Fannie and Freddie versus both of those. So pricing for P&C insurers is quite volatile. Fannie's pricing is much more similar, much more in line with kind of the way that regulated utilities work, where they're seeking to earn a certain return on equity. P&C insurers have many competitors, a fragmented market. Again, more similar Fannie and Freddie here to the utilities in that they have kind of very few competitors. The utilities sometimes are local monopolies, and Fannie and Freddie kind of compete with each other, and then they do compete with private label and stuff, but that's a very different business. The underwriting discretion for P&C insurers is high, whereas utilities and Fannie and Freddie have a duty to serve their markets. P&C insurers have kind of a medium level of diversification. Utilities, by their nature, are not geographically diversified, as we're seeing, tragically play out in places like California, Hawaii, and others. Fannie and Freddie are very diversified across the country. Looking at their financial attributes, P&C insurers earn, tangible returns on equity north of 20%. I think that's reflects the level of risk they're taking, as again was highlighted by recent events. The Fannie's returns and Freddie's returns that we're modeling, again, much more in line with the utilities, kind of a low double-digit ROE to attract the necessary capital. Earnings per share growth, kind of 8% for the P&C insurers, 7% for the utilities, 3% for Fannie and Freddie. Why is it so much lower? Well, it's a kind of a simple lower growth business, but also we're paying out a much larger dividend here than kind of the P&C insurers or the regulated utilities. Kind of their total return earnings growth plus dividend yield is in the 10 to 11% range. Fannie and Freddie at 8%. So if we go to the next slide, please. This kind of shows the trading universe today. And if you kind of take the median of the insurance universe and the utility universe, you get to kind of the comp average. This is not kind of a determinative analysis, just kind of a data point that's obviously very helpful in an IPO process. Everyone looks at trading comparables. What's interesting here is, given the sequential nature of what we proposed, you'll have kind of Fannie go public first, and that will establish a trading price for Freddie's much larger IPO. So when Fannie's going public, you'll kind of have this comp universe. When Freddie's going public, I expect it will be benchmarked kind of solely against Fannie. But and then the ownership, what's interesting here is the Treasury will still own the vast majority of both companies post IPO. You can see the new IPO investors will own much more of Freddie than Fannie because the IPO is larger. Legacy shareholders will own kind of a mid to high teens percentage of both companies. We think that both companies today have widely distributed shareholder bases, so their shareholder bases are not reported like they are for most other companies because they trade on the pink sheets. But we think, many individuals in the United States own these shares and would be beneficiaries of what we're proposing. And then importantly, both of these companies are going to be index eligible, and they would rank in the top 100 S&P 500 companies. So post restructuring and exit from conservatorship, they will be owned indirectly by hundreds of millions of Americans through index funds. Bill went through this already, so we can move to the next slide. So kind of modeling out what the government receives over time. So we model the government monetizing their stakes in both companies kind of ratably in the 5 years after each IPO. So the idea is they would sell a fifth of their stake in the company kind of per year in the 5 years after the IPOs are done. So that's why you see kind of Fannie Mae sales going first and followed by Freddie. They would get dividends in the interim while they own the shares, obviously. We're modeling stock sales at kind of 15 times earnings at a 5% discount when they sell the stock, given that they're selling kind of large quantums of stock. If you add all this up over time, we estimate Treasury will earn well north of $300 billion by monetizing these warrants, which is a huge payment to taxpayers. So there's a lot of debate around the senior preferred out there, and we think some of it is flawed, and we'll kind of explain why. So today, the legal liquidation preference on the senior preferred stock is $340 billion. That's more than both companies are worth today. It's not actually a real number in the sense that you can't convert it to cash. There's no mechanism to convert that to cash. And importantly, Treasury already owns 80% of both companies. So the only mechanism people are talking about in terms of having, if the senior preferred is not written off, well, what do you do with it? The most common idea we see is converting it to common equity. Treasury already owns 80% of both companies' common equity. You could only take your common equity ownership up from 80 to 100. So mathematically, their claim on the earnings power of the GSEs can only go up by 25%. We think that's unlikely to happen. Why? Well, one, any attempt to convert the senior preferred into common would invite a fresh round of litigation. Where we are today, most of the serious litigation has been settled. We're kind of through all that, which provides an interesting window for emerging from conservatorship. If Treasury were to attempt something like this, it would delay the exit from conservatorship well beyond the current administration's term. So kind of the last round of litigation that went up to the Supreme Court was filed somewhere around 2013. It took 8 years to finally settle. And that's well beyond the Trump administration's term. So it would basically prevent this administration from getting this done, which they have said they want to do. And then more importantly, it would prohibit any new private capital raise, because we don't think any new investor is going to buy common stock in these companies, whether it's a primary sale from Fannie and Freddie to raise fresh capital, or a secondary sale of Treasury stock. If the litigation's outstanding and if Treasury does something so hostile to kind of the existing investors. In the very unlikely scenario that an IPO and exit from conservatorship was actually possible, if the government converted their senior preferred, we think that conversion would severely impact the valuation of what they're converting into, right? So you're converting your senior preferred to common shares. If doing that nukes the value of your common shares, you're actually worse off by doing it. And we think investors would assign either a really low valuation multiple to those common shares if this were done, or just not invest at all. And then the Treasury would basically be stuck with these common shares on balance sheet with no way to monetize them. And if we show on the next page.
Actually, by the way, the other point would be,
Yeah.
they'd have to consolidate kind of both enterprises. So, that's a problem with respect to all the debt that's outstanding. And another thing I'll point out here, the government was saying prior to Fannie and Freddie going to conservatorship that they were solvent, there was no issue. They were forcing them to raise capital. They issued a lot of this preferred very shortly before, in the period just leading up to the conservatorship, and that the preferreds were bought by the biggest asset managers in the world, the BlackRocks, State Streets, all these kinds of sort of institutions. The common stock here was held very broadly by millions of small investors, but this was, the ultimate sort of institutional stock in almost pretty much every portfolio, certainly all the indices. So there are a lot of very unhappy people kind of going into, the institutional memory of what happened with Fannie and Freddie is not a good one. And so, that puts a little bit of a taint on these companies. I think it's helpful that we have a Trump administration, was not involved in the net worth sweep. But the incremental perceived benefit of squeezing out the common stockholders when you own 80% of an institution already, and then to Anthony's point, who's going to want to step into, a company owned 100% by the federal government? Who steps into that overhang after they did this? And the answer is it's a zero set. This is Anthony's point about the common stock they would own would be worth a fraction of what it would be owned when it has an institutional long-term base, that index eligible. This would not be an index eligible company. One other very important point here is that conservatorship is a process that's an important one, where financial institutions are managed through challenging periods, and the and it's important that they're handled correctly. This one has been in conservatorship for, whatever, 16 years. I'll read a quote. 87 years of FDIC, FSLIC, RTC history demonstrate that conservators are caretakers who are not meant to operate an institution indefinitely. Conservatorship is supposed to be a temporary measure leading either to rehabilitation or to receivership and ultimately payment of creditors and shareholders. Nor do federal conservators or receivers act for the benefit of a single preferred shareholder, the government, to the detriment of all the institution's other shareholders. Such unprecedented deviations from settled insolvency practices and creditor protections undercut one of the critical foundations of a market economy and could call into question the reliability of the government as a resolution authority. The consequences to future resolutions, and many resolutions require raising capital, selling institutions, et cetera, and taking this kind of violent action would damage that. There have been 4,000 conservatorships, and importantly, in each of those, recognized that the preferred is entitled only to its contractual repayment with interest. A quote: "In open bank assistance and conservatorship, the stakeholders' interests are protected by their contractual rights since the institution is continuing to function as an open and operating company, provided the assistance, formerly the FDIC for banks and Treasury for the companies, receives repayment plus interest like any creditor based on the assistance agreement. All past open bank assistance and conservatorships, all principles underlying HERA, related insolvency statutes, limited that repayment to the actual funding provided as the statutory goal explicitly is to restore the company to a sound and solvent condition. That cannot be accomplished with a confiscatory seizure of current and future value." I think critically important points made here. An argument for the government returning the 25 billion extra that they received in extra contractual payments. This came out January 9th, and Craig Phillips joining Freddie Mac as Executive Vice President, Corporate Strategy, External Affairs, work with the CEO, the president, entire senior leadership team to support the dynamic evolution of the company's strategies. External affairs includes industry engagement, regulatory, and conservatorship affairs and initiatives. So Freddie and Fannie are preparing for release from conservatorship. We think the timing is excellent. We're in a strong economy. Unemployment is low. GDP strong. National home prices all-time highs. Stock market all-time highs. The senior preferreds have been repaid with more than their contractual return. We need to raise capital to delever our country's balance sheet. This is, very DOGE-aligned initiative. Again, the conservatorship itself, the FHFA has grown significantly in terms of personnel. I'm sure those personnel would prefer, there would be lots of opportunities for private sector jobs, but if they were not effectively overseeing this company, we could, find some efficiencies. In government, we're at the beginning of the Trump administration. We have 4 years pro-business administration led by, as we say, the consummate deal maker. So we began with the art of the deal, and we end with a quote from Donald J. Trump: "Deals are my art form. Other people paint beautifully on canvas or write wonderful poetry. I like making deals, preferably big deals. That's how I get my kicks." I'm somewhat of a deal maker myself. What happens with deals is you get kicks from bigger and bigger deals. The president's done a lot of big deals. This would be the biggest deal he's ever done. It would be one that would resolve kind of one of the really the last remaining sore from the financial crisis, would restore fairly, respecting the hierarchy of claims of the various participants here. It would release these really remarkable companies in a really important mission business for the benefit of the country. It would create a lot of shareholder value for the millions of shareholders that frankly got screwed by the net worth sweep that took place during the Obama administration. This is something that the president has publicly committed to do as recently as several years ago. He's now really well positioned to get it done. Interestingly, I don't think, my guess is the Scott Bessent hearing wasn't scheduled to occur at the end of the Pershing Square presentation on Fannie Mae and Freddie Mac. I sort of randomly picked this date a few weeks ago to give us enough time to get our presentation done. But we made sure to finish in under 90 minutes, so we can hear from the Treasury Secretary to the extent that he mentions Fannie and Freddie. But we're quite excited about the potential here, and we appreciate your taking 84 minutes of your time. We will be releasing a copy of the presentation. If you have additional questions, just reply with those questions, and we will do our best to respond to them. Thank you very much, and have a great day.